Hello friends, welcome to my channel Talk the World. Do you know what is the most profitable fund in the world? It's not buying stocks or cryptocurrencies, but a very mysterious financial product called catastrophe bonds. You might say, what kind of bonds are these? Catastrophe bonds are bonds that deal with huge disasters. They're called cat bonds for short. The return rate in 2023 was as high as 20%. Some people may think that 20% isn't too bad. Bitcoin can even rise by 20% in one day. In the financial world, if you don't look at risks and just talk about returns, it's like cheating. Otherwise, why would you keep your money in the bank? Just buy Bitcoin. Let's take a look at the performance of US bonds in 2023. And this is the performance of cat bonds. You can see that not only does it have a high yield, but it's also stable. You must be curious. What kind of product can get such a stable 20% return? Are those cunning capitalists coming up with some deceptive products again? Let's take a look. What exactly are cat bonds? Actually, the concept is quite easy to understand. It's similar to buying ordinary bonds. You will receive interest regularly, and when the bond matures, you will get back the principal. The only difference is that you are actually betting against nature. If there is a major disaster, such as hurricanes, floods, fires, earthquakes, etc., then sorry, according to the severity of the disaster, part or even all of your investment capital may be lost. Of course, the so-called natural disasters are not a vague concept. Each bond has very strict restrictions on time, location, and types of disasters. For example, there is such a bond. It matures in 5 years. If there is no disaster during the 5 years, you can get an annual risk-free rate plus 10%. This is your total yield. However, if a hurricane occurs in Florida within the 5 years, for example, if the wind speed reaches a certain level or a named hurricane lands in Florida, then the disaster has occurred and you need to compensate according to the terms agreed upon beforehand. There is a very high probability that you will lose all your principal. You can imagine it simply as putting your money in the bank and getting an additional 10% interest per year. But if a serious hurricane hits Florida, you'll lose your money. The system I just described is a Florida hurricane cat bond. This is not an example I made up. This is actually a very popular type of cat bond recently. Why? Because after the pandemic, many people started remote working. They moved away from crowded places like New York to places like Florida with pleasant weather and live like they're on vacation every day. As a result, the housing prices in Florida have risen, and the supply of houses has increased. More people are buying insurance. And the biggest object protected here is hurricanes. This is how it connects to the Florida hurricane bond. How exactly it connects we'll talk about later. Similar ones may include California wildfire bonds, Japan earthquake bonds, New York flood bonds, etc. Last November, a new type appeared. It's called Cyber CAB, which means if a company is hacked, it's considered a disaster. It's really imaginative. I don't know how they define being hacked. Anyway, let's come back to the question. Why would anyone buy this bond? It's simple. Because in the absence of disasters, it's really profitable. We just talked about the Florida hurricane bond. Its risk premium has reached 10%. I checked it out, and generally speaking, this type of bond has a risk premium that ranges from 3% to 15%, and in recent years it's been above 8%. So it's quite tempting, right? But how high is the corresponding risk? That is, what is the probability of disaster happening? Generally speaking, it's between 0.5% and 2% per year. In other words, you only need to bear the risk of losing money at a rate of 0.5% to 2% each year to get an excess return of 8% to 10%. Sounds pretty good, right? But if you think about it intuitively, his profits can be stable at this yield level, which definitely isn't something ordinary people can play with. In fact, it's true. You hear he's already making so much money, but only a few hedge funds with extremely strong professionalism are active players in this catastrophe market. However, we're talking about these hedge funds with extremely strong professionalism. Their professionalism isn't about mathematical modeling, quantitative hedging, etc., but rather predicting weather and earthquakes. You have to accurately calculate the probability of a disaster occurring before you know whether to buy this bond or not. Otherwise, even if you're lucky enough to buy it once or twice, it may not necessarily be more profitable than keeping your money in the bank over the long term. So it's actually quite funny. The buyers of these catastrophe bonds are hedge funds whose researchers spend their days studying things like weather forecasts and geology. NVIDIA always promotes its AI chips as being very good at calculating phenomena like hurricanes. I'll tell you, they've bought a lot of graphics cards for these hedge funds. And these hedge funds use them to predict the probability of future disasters as they trade these bonds. They don't just calculate the probability when they want to buy the bond. Instead, they constantly monitor the probability of a disaster occurring and decide whether to trade the bond based on that. For example, let's say Hurricane Zeta hits Florida. If there's suddenly a hurricane forming off the coast, moving towards Florida, the price of the bond will plummet. The higher the probability of landing, the harder the bond will fall. Suppose you're a holder of this bond, and you can predict that the hurricane might hit, you sell it first to avoid huge losses. On the other hand, suppose the market assesses that the probability of landing is 60%, but you're very professional and after careful analysis you feel it won't be that serious. Then you can actually jump into the market to buy cheaply, buying up a lot of these bonds. If the hurricane turns out exactly as you predicted, it just brushes past Florida without causing any actual disaster. The bond price will immediately rebound, and you'll make a big profit. For example, let's say California is on fire. At this point, these fund managers may use all available resources, such as satellites, to try to figure out where the fire is and estimate the size of the fire to determine whether it will cause a real disaster and trigger the bond compensation. I believe you should feel it. This money is not something that ordinary people can earn. And this 10% excess return is also not something that ordinary people can get. Speaking of this, some friends who like to think may ask a question. It's wrong. Even if there is no disaster, his excess return is only 10%. Why does the bond yield 20% in 2023? Let me reveal it for you. This actually because in September 2022, the United States experienced a hurricane called Ian. This Ian became the most destructive place in Florida since records began, with cumulative losses exceeding $100 billion, triggering several catastrophe bonds compensation mechanisms. So after that, investors were a little scared. They felt that maybe global climate change was making extreme disasters more likely to occur, and the severity of these disasters was increasing. They didn't dare to believe their original model anymore, and they didn't dare to buy the bond anymore. So the price of the bond started to fall. So the entire catastrophe bond market had negative returns in 2022. Later in 2023, nothing major happened. Not only did it not trigger any large-scale compensation, but it also allowed investors to receive interest payments, and the price of the bond gradually recovered, which made the annual return in 2023 about 20%. So at the beginning we said that 20% was just a gimmick. It was also the highest return on catastrophe bonds in history. If you look at the historical returns on catastrophe bonds, they are usually less than 10%. They are definitely higher than government bonds, but they will never reach 20%, so exaggerated. We'll take a look at the people who bought the bond. You can see their income situation. If nothing happens, they can get a stable income, but if a disaster occurs, they will suffer heavy losses. This is equivalent to what? Isn't it a bit like providing an insurance? A major disaster insurance. Then let's think about who would buy this insurance. Or in other words, who would issue this bond. That is, once a disaster occurs, who will be compensated? The main one here is actually the insurance company, because once a disaster occurs, the insurance company will have to pay a lot of money. So they will issue some catastrophe bonds, equivalent to hedging part of the risk. There is a certain type of issuer, that is, various government agencies, such as state governments in the United States, like the New York state government. Once the flood swamps Manhattan, he will suffer huge losses. He might be able to do nothing, issue a New York Manhattan flood bond to hedge against this risk. And then there are countries like Mexico, Chile, and Jamaica, whose financial markets are not very developed. They will ask the World Bank to help them issue some catastrophe bonds. So if you buy this catastrophe bond, you are actually providing insurance for the insurance company. or providing insurance for various governments and the World Bank. You are really amazing. Let's take a look at the whole chain of catastrophe bonds. Like us ordinary people or ordinary companies, we need to avoid some risks. We will find insurance companies to buy insurance. As for the insurance company, a large part of individual risks can indeed be smoothed out through enough numbers. For example, the risk of car accidents, the health risk, which is also the basic logic of insurance companies, by spreading everyone's risk through large volumes. But for this kind of catastrophe insurance, it's different. Think about it. If a hurricane hits Florida, half of the homeowners may come to you to claim compensation. Who can bear it? For this systemic risk, insurance companies, they actually cannot reduce risks by using large volumes. Even if they have money or the government has money, they can't withstand the losses caused by disasters. But they need to reserve a lot of emergency funds to deal with extremely small probability events. Actually, this is not economical for them. For example, if you are worried that your house may face 1% chance of disaster brought by hurricanes, you can put half of your assets in the bank and keep them as a deposit, in case of emergencies, right? This is definitely unrealistic. Your ideal choice is to buy an insurance policy, right? Insurance companies are the same. They also need to issue some catastrophe bonds to hedge their own risks, or transfer risks to the market. And investors on the market don't like these bonds. Why? Firstly, the yield is high enough. And secondly, there is one very important point. That is, the correlation between catastrophe bonds and other financial assets is almost zero. Think about it. The price fluctuations of catastrophe bonds basically follow the probability of disasters, such as windstorms and earthquakes, and the fluctuations of stock markets. Even if they are not completely unrelated, they are almost irrelevant. This uncorrelatedness is good for asset allocation. You can greatly reduce the volatility of the entire asset portfolio by allocating part of your assets to catastrophe bonds, which is equivalent to helping investors reduce their investment risks. This theory was introduced in detail in the episode of LTCM. So consumers transfer part of their risks to insurance companies by buying insurance. And insurance companies transfer part of their risks to investors by issuing catastrophe bonds. Investors then lower their investment portfolio risks by buying these bonds. Do you see it? In this securitization mechanism, consumers, insurance companies, governments, and investors all reduce their risks. Note that the cost of disasters does not disappear. Your house gets blown away, still falls down. The loss is still there. But what these catastrophe bonds do is to help the whole market share the burden and compensate you. The clever thing about this mechanism is that these catastrophe bond investors buy these bonds not because they are morally upright, but simply because they want to make money. You don't need to rely on their moral standards, and they are not profiting from disasters. On the contrary, they are the most afraid and least willing to see disasters happen among all market participants. Look at these bonds. They attract such a group of highly professional people who spend their days studying, saying that, how likely is it that a disaster will occur? Will it happen? And once it happens, they will use their own deposits to compensate. This division of labor, does it seem reasonable to you? You might feel that this catastrophe bond sounds like another fancy product packaged by Wall Street, but after our analysis, you might feel that it's not too complicated, and no one can understand it. It indeed helps society to rationally allocate risks and benefits through financial market securitization, and purely driven by interests. Isn't it amazing? This might be the charm of finance. Well, that's all for today. Subscribe to see more exciting content next time.